Here we go. Hey, what's up, guys? Thanks for joining me again, or us, really, I should say, for our third ever episode. I hope that it gets to the point that we just stop like counting, right? I used to do the same thing when I was driving in Houston. I used to count how many times I would almost die from getting hit. But now it's just too many to count. No, I'm just joking. I mean, kind of. But yeah, man, thanks for meeting up with us again. And anybody out there, just thank you for viewing and being with us too. We got a cool show, a lot of going on in the news this week. The market's like super crazy. But I think it's getting better. I hope it's getting better. I saw a little bit of a rebound on Thursday, so I'm hoping we bottomed out. You know, the Fed had their call and gave us or really confirmed some rumors. I have some feelings about that myself, but we could talk a little bit more about that. But of course, I'm Josh Flores. I have Misael and Gonzalez and Josh Trusty. Of course, Mark's out for today, but he wishes best for us. But before we get too far ahead, Misael, did you want to pray for us?
Yeah, for sure.
Cool, thanks, man.
Lord, Jesus, thank you for our time this morning. Thanks for that you lead our conversation as we kind of talk about what happened during the week. Thank you for the viewership that we have so far, and I pray that you will use it for your glory. We give you thanks, and we pray this in Jesus Christ's name. Amen.
Amen. Cool, man. So one thing that I think that we're going to point out, which I think is going to be more of a weekly thing, and I can share my screen here. We're going to start off with this VIX. Can y'all see that, by the way?
Yeah.
Yeah, cool.
Yep.
Screen looks funny to me, but yeah. So I don't know why it says VIX oil, but I like looking at the VIX. You guys know, fear index. Obviously, this is going to tell me really if I need to buy or not, right? My dad always told me if it's at 30, that's definitely a good time to buy. So of course I know that earlier this week, so we look at the 5-day, I think it was like well above 30. Yeah, hit 37, almost 40, you know? So that's definitely telling me that stocks are still on a buy. I mean, it's at 27.6. It's down 16% this whole week. So that's good news, right? But of course, year to date, we're still up 66%. So very interesting times. With that being said, we can see that the NASDAQ still down 13% on this year. And this is that rebound that I was talking about right here. So it looks like just in the past Thursday through Friday, just Friday, I should really say, it was up 3%. So if you're holding TQQQ, you were probably up like what, like 9%? Is that right? Keep me honest here, Josh.
I think it was a little less than 9%, but yeah, it was a pretty good bump up. Although in the greater context of TQQQ, still like almost like no gains, or like maybe a 12% gain over like 1 year.
Yeah. Which is
so a lot of those gains like have been erased.
Yeah, yeah, I was about to say that because I mean, at least this week we know that it's gone up like a little bit, at least 6%, right? But you know, in the past year, like you were saying, you know, that's relatively reasonable, right? If it's up 5% in a whole 253 trading days, you know, if we look at the S&P, you know, I that's like my measure too. When I've been trying to look for stocks lately, I've been trying to look for the S&P. So knowing that it went up 2% on Friday is pretty nice. This week it went up 1.7%, so that's, you know, roughly around 3% for UPRO. Year to date, still struggling. They were talking about the correction territory, you know, being around 10%. So we got super close to that, which I don't know if I can really go back. Let me see, 1 month. 1 month it was down 7%. So barely missing correction territory there, but not to say like it won't, right? But last one that I'll probably look at right here is just the Dow Jones. Dow Jones is like a funny one to me. It's like I know that Microsoft and Apple too that had some pretty good earnings, you know, and so they were leading the Dow here. So that was pretty cool. You see their 5 weeks up 1.92. I'm not triple leveraging or double leveraging this at all, but I've thought about it in the past, and we talked about it like last week about it or the week before, but still not necessarily into it. But of course, we have our Bitcoin here, which is super volatile, which is like Bitcoin always, we could always have a conversation. We could probably have a TV show about Bitcoin, really. But year to date, still struggling, down 21%. 37, that's still a pretty good price. I've heard it once said that the idea is greater than the price. So, it's still kicking on to that. I'm sure that Ethereum and some of the rest of the tokens or coins, I should say, are really still pretty good as well. Energy, of course, and we're going to talk a little bit more about this. Obviously, being in Houston, Texas, they're really big on the energy here and the oil and gas. So excited to see this above 85. I think during the week it actually hit like 88 at one point. I think I've seen a title from the Wall Street Journal that said that it might have hit 90. I don't really know. I don't follow it like that, but I know that there's just some plays that I've been doing with oil and gas with that. But with all that being said, I hope that everybody's trading weeks have been good, or if you've been buying at least, this is definitely to me a good time to buy. I mean, like, why not, right? The S&P 500 I think is only had like a losing year like twice ever in its history. So whatever people are saying, I would just say keep buying. But that's my weekly wrap up for you guys.
Definitely saw some correction activity this past week, which is kind of driven by the war rumors and Fed increases inflation and stuff like that. But yeah, I mean, corrections happen every once in a while, like maybe once a year, maybe they happen. But if you look at the overall, trend of the S&P, I mean, it's still up probably like 70% year over year. So yeah, nothing to be worried about. Things are on sale, obviously, and yeah, good opportunity.
I think
it's also important to like see like the forest like through the trees. Yes, there might be a correction like here and there, but really the stock market is one of like the greatest wealth producing engines of our time, or pretty much any time. And so it's important just to continue to be diligent and have that discipline, and not let your emotions get the best of you and then sell at the bottom, which is pretty much the exact opposite of the old adage, like buy low and sell high. So it's just important not to get emotional and sell and then actually take a loss, rather than staying in the game and just waiting it out, because like all of these like micro trends will eventually smooth out as like the larger trend of continual growth, which is driven by productivity, pushes the stock market upward as it normally does.
Dude, yeah, I think this did I share this article with you guys? But I saw this earlier this week. I think when I first like saw it, I was actually driving, so I played like the audio of it in my car as I was driving. I don't think it's a very long article. Oh, I guess it's 8 minutes, which is pretty long. But this guy, Jason Zewig, I thought this was just a pretty encouraging article. I think that the most impactful part of it to me that I got was he said, like, it doesn't matter like what happens in the market. The only thing that does matter is how you respond to it. And so I thought that was like a very interesting thing. And, there's this really easy chart here that goes back to 2010. Obviously, this is like before the 2008 financial crisis. We obviously have the COVID crash right here in March 2020. But yeah, I mean, all these just like show opportunities. And so like right here is like clearly an opportunity, right? And yeah, I think that I'm trying to remember one of the things that I heard from CNBC this week, but I think what they were saying is like basically we can count like how many like market crashes there's been like on our hands. You know what I mean? Like there hasn't really been too many. I think that they say like it happens like once every decade, which is why everybody's saying, oh, the market's gonna crash. And it's like, well, if I say it's gonna rain every day for like 365 days, I'm sure I'm gonna be right eventually. You're never gonna be wrong if you publish a video every day saying there's gonna be a crash. But yeah, and they were saying that like these corrections, like there might have been like between like 20 to 30 of them since like the inception of like the market, like the S&P, I think back in like the 1800s even, you know. But and like correct me if I'm wrong here, but like just the way that it works in the US, like that people are buying the S&P 500 every day with their retirement, you know. And so it's like, why not invest in the S&P 500 or companies in the S&P 500, because they're gonna like intrinsically just go up, right? If somebody's literally buying it every day, you know. And so that's obviously going to change that. But were you going to
Yeah,
say
for
something?
sure. No, yeah, I was gonna say like, yeah, corrections are natural and healthy. I mean, the market goes up, and obviously it's like a runner. Uh, you know, sometimes you have good legs, sometimes you have not as good as legs as previously, but yeah, these are healthy things that the market does, and obviously, you know, this week was driven by like big news. So sometimes you get some of those perfect storms where like there's not so positive news in the going on, and then the market seeing some activity, and then all of that combined kind of drives this kinds of movements. But yeah, definitely a good thing for the market for kind of like this drawback to happen.
Right. And just as like a follow-up to what you were saying, Josh, is just that there's basically no one on the sidelines in the economy. Everyone like has their part to play, and a lot of people who are like investing into like their retirement, they end up like putting money into like these ETFs, which are consistently buying more of the S&P 500 or of different ETFs and like stocks in general. So in general, money is continuously being poured into the stock market, but of course there are going to be fluctuations just due to different due to, like the news cycle, just like fear, uncertainty, and doubts, and just like just natural fluctuation as people like reevaluate their convictions.
Yeah, and we got to remember, I mean, yeah, like Josh Trusty said previously, that stock market is one of the biggest wealth producing machines that has ever been created. And obviously right now, the way it works is that, you know, people at the top get supported from the bottom, and people from the bottom get supported at the bottom from even lower spots, which kind of sounds like a pyramid scheme. But I mean, there's a lot of, you know, the government is backing it up. There's actually good companies that actually do produce products and produce profits. But anyway, right now, like the baby boomers, we're supporting them, right? Because when we started, you know, getting a paycheck, we started contributing to a 401k, and so they saw a kind of a bit of a bump. Right now, we're seeing, you know, a bump from the people who graduated 4 years ago. You know what I mean?
Mm-hmm.
It's kind of how it works. It builds on top of each other, and that's why, you know, the overall trend is up. If you look at like a longer timeline, and so and obviously within those times, I mean, there's people, I mean, companies do fail, companies do spectacularly, and but yeah, for sure, always have a positive outlook on the market, and just make sure you're watching out for what's going on in a macro level, and in the economy overall.
Yeah. I know that I know I've been kind of like taking a lot of this too, so you guys can stop me if I'm doing too much, right? But I think the biggest thing that really is kind of striking this, I know like a couple of things that we were going to talk about today, but I did want to obviously bring up these interest rates. You know, it's the thing that everybody's been talking about this whole month. And so obviously Jerome Powell, the Fed chair, had his first meeting of 2022 on the 25th and 26th of January. He got up there, and you know, I don't think Jerome's like I don't think he's like a terrible guy, right? But sometimes he just kind of gets to me, right? And like we were talking like earlier this week, and I was just like, man, did this guy actually tell us anything that was like of value, right? Like everybody's been talking about, oh, the Federal Reserve is going to raise interest rates. They're going to do it like in March, and you know, they're going to reduce their balance sheet. And then this guy gets on TV and he just says, oh, it's all true. You know, it's like, okay, you know what I mean? Like, okay, now what? Then he just says, we haven't made any decisions. And it's like, what does this guy do all day? You know, like,
Yeah, I mean, I think I always thought it was interesting that, you know, if you look at previous Fed chairs, you know, Bernanke or Janet Yellen or some others, our current Fed chair is not an economist. His background is he was an investment banker, and he's a lawyer.
Yeah, I saw that.
So it's kind of, I think it makes more sense if your Fed chair is an economist, because you always look at a macro level, you know what I mean? And you're not always just so focused on the stock market. You're focused at wages, you're focused on, social, if the poorer segments of the population are doing good versus the more of their richer segments. And so I always thought it was, Jay Powell was like an interesting pick, because he doesn't really have, as good as a background as previous Fed chairs. So definitely has a unique style to him. And another thing I would like to say is he's acting very different from, the way that he was acting under Trump. Right now, he's supposed to be unbiased and he's not maybe either political at all. But I mean, he wasn't acting like this when Trump was around. He's definitely being more aggressive, and it's probably driven by the inflation, which is good. But definitely seeing like a big shift in his approach to the economy. So that's very interesting to see.
Yeah, I was like paying special close attention to the Wednesday meeting that they had, and so it seemed like things were going pretty well up until Jerome Powell started speaking. So I guess so out of that conference, one thing of note was just that we're gonna get a rate hike in March, but also just the way that Powell was speaking about their strategy. It just seemed, even though it wasn't anything necessarily new, it was just kind of the way that he was like saying it. So for example, if you say to somebody, everything's going to be okay, everything's going to be okay, everything's going to be okay over and over again, it kind of gives the impression that things aren't okay or they're not going to be okay. And he did say something like of this nature, like throughout the conference. For example, he mentioned we're committed to our price stability goals, which is a way of like saying that, oh yeah, we're committed to controlling inflation by raising rates. Okay, that's nothing new there. And then he also said, I think there's quite a bit of room to raise interest rates without threatening the labor market. And that's a direct quote as well. And then he also said that the economy no longer needs sustained high levels of monetary policy support. And all three of these quotes are just a way of saying that we're going to raise rates, which is not new information, but also it would just like having all of these three quotes like in that conference call was just that it kind of implied that we're going to raise rates even more than anticipated before, especially with the second one where he said, like, I think there's quite a bit of room to raise interest rates without threatening the labor market. So I didn't really get too much confidence like from like,
which means that means that, if he's willing to say that he's not worried about the labor market taking a hit, that kind of says that the labor market at the moment is garbage, and which is, I mean, a lot of people are not wanting to work and a lot of employers are needing help. So it's kind of funny how, 2-3 years ago, yeah, it's all about the labor market, but now that it's like almost, it's nothing compared to what it used to be a year ago. Now he's like willing to say, well, yeah, it's not going to affect the labor market because it can't get any worse than what it currently is, So that's just kind of interesting, and how just things really do change a lot from like year to year. So.
Right, especially given like he was previously saying that, oh yes, inflation is going to be transitory. That narrative is fully dead. It's been buried, and now we're coming to grips with the effects of inflation. And I think, as we know, whenever you are increasing like rates, like yield rates, then that actually can slow an economy down. And so he doesn't really seem to be too worried about that because the economy is really red hot at this time. And so the labor market, at least according to Powell, can certainly take that hit because we have so many vacancies already as it is.
And dude, to kind of rebound off of that, dude, I think that kind of reiterates kind of what we've been saying like earlier in this call too. I mean, yeah, labor could be a little bit better. I did see like an article saying that like the hottest jobs right now are like kind of like low level like jobs, like some of those like blue collar, I hate to say it like that, but they were saying like they need like store employees, and like people that are like in the highest like demand right now are people who just like graduated high school. You know what I mean? And it's like all of us here are like professionals here. We've been very blessed in the sense that we've been able to have the opportunity to go to college and earn a degree and or degrees, and so we all have like these like careers, but these people that like don't necessarily have that opportunity or in that position, it's like they're in the hot seat right now. They can start calling the shots. I've always kind of wondered like, man, can I like if I stopped working right now at my employer and started working at Walmart, could I actually make more per hour? I've thought about it.
Yeah, it's interesting. Obviously, you kind of have to look at the big picture. I mean, going to college was like the thing to do in the past 20 years, right? Like if you wanted to have a life, you need to go to college. And so since it was pushed more like obviously more people went to college, but then those other jobs, like you were saying, plumber, carpenter, construction worker, they were kind of like ignored a little bit. And now that college, the reason why college is so expensive at the moment, supply and demand, is because a lot of people want to go to college. But there's not enough people that want to do those other jobs, plumber, truck driver. I mean, you can get like $100K driving a truck for Walmart. You know what I mean?
Mm-hmm.
And I think Mark Cuban said probably like a year ago that those jobs are going to be the ones that are going to be, like you were saying, hot because they've been ignored for such a long time, right? And now, and obviously college is not for everybody. Some people just don't do well in the classroom, having to listen to someone for an entire day through several classes and stuff like that. So we do have to pay attention to the market that is more focused on working around the house or construction or plumbing or stuff like that. So that's an interesting shift for sure.
And even like culturally, I think there is kind of this narrative that some of these like service industry jobs could be automated. And for that reason, they didn't like pay livable wages. And I think now we're in a situation where we do like have, I guess, like only we're on the cusp of like some technology that can automate these jobs. But overall, we don't really have the ability to just instantly flip a switch and go over to automation. And so I think that we're realizing overall in this entire economy that these are the service and industry workers actually have quite a bit of power over their own fates, which is good news for them. So I think that's definitely what's driving the inflation. Now that they have more ability to bargain and actually get paid more for the valuable work that they put into the economy.
Yeah, I know that I know we've been having a good conversation about labor and everything, and I know it's definitely related, but I do want to bring up the fact that these are the dates that the federal chair will be meeting and speaking, and they'll probably be on TV, on YouTube, wherever it needs to be. And so, of course, that's when we had the call. We heard all these things that we're speaking about right now is from the 25th and the 26th. And that's when he was on, that's where I watched him from, was on CNBC. And so I think that people are looking towards this date, this March 15th and 16th here. And that could be the date where he gets on TV and he says, hey, we're hiking it. Who knows really how much he's going to hike it. I think that up until this point, up until about January the 26th, which was a Wednesday, up until that point, everybody was scared that, okay, are we going to raise interest rates or not? Which I think everybody knew that we were, right? We've been talking about it for 3 months. We probably should have done it like a year ago. But either way, this could be the date where we see our first rate hike, right? Potentially, I don't really know, like, it's really up to him, right? He's going to be like, at the end of the market, at the beginning of tomorrow's day, like, we're going to see an interest rate hike of 0.25% or even 0.5% or something like that. But I think that the fear today on this date, January 27th going forward, is that they're afraid that the Fed is going to overcorrect this, right? I think that we saw inflation data that was at 5.9. I think that came out like yesterday or the day before. Obviously, the the one before that was around 7.1 or 7.2. So like it's still extremely high, and it's very it's comparable to like historic years, right? But that's like quote unquote better, right? Yeah, I don't know if you guys want to write those down. I can share this article with you guys. It is a government website, so I don't know if I'll get in trouble for sharing this, but who really who really knows? I guess YouTube will tell us more than not. But same thing with the Wall Street Journal. But yeah, that's just some things to kind of look out for. I think those dates we ought to put those in our calendar, or like get like a week in advance and just be like, hey, like not even like an issue coming up, right? Like we don't believe that there's issues in the market. We only believe there's opportunities here, at least in this group, and hopefully for those who are listening. But just wanted to point that out for you guys.
Yeah, I mean, it's the Fed is obviously it's a super tough job because you have a lot of influences that are trying to pressure you to do something or not. You know, I wonder now if investors are okay with the Fed raising rates, because now there's an actual physical, not a physical, but like we can actually see that the inflation has gone up. And when there were, you know, people were just talking about raising rates when none of that was happening, right? I mean, record highs in the stock market, employment was super, I mean, the best it had ever been in 50 years. I mean, it makes more sense to raise them now. So I wonder if they see this as an okay thing to do or not. I would definitely agree with the fear that, you know, once they get started raising rates, right, they may just go crazy with it.
Mm-hmm.
So they will have to be very careful about how they approach this. Maybe, you know, and also by how much, maybe like 25 basis points, 50 basis points. They have to really try to understand all aspects of this for them to not mess up, you know.
Yeah, yeah. I think that it's some eggshells out here, right? Like I kind of wish that I had some tools, and it'd probably take some time to kind of really digest what exactly is kind of going on. I mean, I think there's too much information. It sucks because it's like public, right? But I mean, there's just so much of it. Maybe we should create some kind of a tool that kind of helps us with like our indicators, that kind of helps us internally, like Wall Street Saturday internally, to kind of like predict or kind of help us understand something. But kind of like going off of that, actually, I just said the word predict, but not to like rehash this here, but you mentioned about Jerome Powell not being like an economist, and you know, Ray Dalio, our boy, our knight in shining armor for our group here. Yeah, he in his book, I don't remember which one it was. I don't remember if it was Principles or his Changing World book, but he mentions about how finance people think differently than economists, right? And in the sense that like politicians and economists, like the way that they're taught in school, the way that they do all this stuff, they actually respond to what's happening right now. And what finance people do, like what, you know, just that people in general, maybe people like us, I would love to be a part of that group too. But what they do is they actually try to predict like what's going to happen and how to like respond to it, you know. But I know that you were about to bring up something, Josh. That was my little fun fact for the day.
I was just going to mention that it might be interesting to try to make some sort of metric that associates, we're trying to find some sort of correlation between like these Federal Reserve meetings and the actual stock market. So we see like, well, what's the correlation between the two? Because I would wager right now that overall there would be like a negative correlation between these Federal Reserve meetings and the stock market. So for example, once you have like a Federal Reserve meeting, Jerome Powell speaks, and then like the stock market just goes down. So I think that's been more of like a trend as of recent, but actually quantifying that over time, maybe as some sort of metric, would be interesting. Because I think in that case, you would then know that, okay, before the Federal Reserve meeting happens, I should just get some money in my account so that once the stock market goes down, I can just buy some more.
Yeah.
I like how you put it, you know, accountants look at what happened in the past, finance people try to predict what's going to happen in the future, and then economists kind of analyze what's already happened, and it's happening right now. I always knew the forwards and the backwards, but I hadn't found like the middle ground, and it sounds like economists fit perfectly in there.
Yeah. It's something that I always struggled with in school, dude. Actually, it's funny because when I was going to KU, I got my degree in accounting, and they have certain requirements that you have to do. I actually had to have calculus 2, man. To graduate in the business school, you actually had to take math up to calculus 2. Man, I don't remember any of that stuff, man. And I wish that I did. But one of the classes, of course, you had to have like 2 economics courses, man, and like I really found them interesting, but I just like couldn't do it, And yeah, like I am an accountant, man, but dude, honestly, I was so better at like finance than I was at accounting. Like I probably should have done that versus, like I would get A's in my finance courses and like B's in my accounting courses, like it's kind of funny when you say that. I know we're getting off topic here and just trying to have a little fun.
No, yeah, I mean, I was pre-engineering before I went to finance, so I had to take like the engineering Cal 1 and Cal 2, but Cal 2 was like the most fun for me. And as opposed to you, my economics was hard to understand at the beginning, but especially the microeconomics, but then the macroeconomics makes a lot of sense.
And calculus actually ends up being very helpful, like for say things like modern portfolio theory, in which you can just basically use calculus to optimize like the effectiveness of your portfolio in terms of the risk to reward ratio over time. So yeah, it does seem strange to some people, I guess, too, why calculus is taught in some business courses, but it actually ends up being very, very helpful when you're doing some like high-level calculations on which stocks should you be purchasing, or what the combinations of stocks or securities you should be purchasing.
Dude, if that's the case, man, maybe you can give us a lesson on that. I mean, I don't really remember like calculus too much, man. There was a point at KU where I learned that I had to stop challenging myself because it was just too much. You know what I mean? And I was like, okay, I don't want to like gamble with my grades here and my GPA, And so, but man, maybe one of these days, man, you got to show us like, what do you mean by all that?
Yeah, so like maybe we can do like a tutorial at some point or an introduction to modern portfolio theory, and just show like how calculus ends up working in the background, like for some of those calculations, which actual hedge fund managers use to make sure their portfolio is optimal for like for the market. So for example, just like a quick primer. Everybody knows that whenever the interest rates rise, like for say the 10-year yield, people begin to sell their stocks in the stock market, or because of that, partly because of fear. And it might not seem intuitive because the 10-year yield is like what 1.7% or so, like per year, and like the stock market will give you something like 10 to 15% a year on average over its entire history. So why would someone go like sell their stocks and go purchase and just go like invest in bonds? The answer is actually because in market portfolio theory, there's actually some sort of combination between stocks and bonds that will actually give you more bang for your buck. That is, it will give you a better risk to reward ratio than just one or the other alone. So in that case, and in that sense, it actually makes sense for some investors to start selling some of their stocks and then buying more, and then investing in more bonds, so that the combination of the two will protect them and actually give them a greater return on investment than just investing solely in the stock market. So that's kind of like what drives investors' decisions, because it's not that they're saying, hey, I'm just going to dump all of my stocks and go straight into the bond market just because maybe the bond market goes up by maybe 50 basis points or 0.5%, but rather it's just that they're taking into account modern portfolio theory, and they understand that investing more in the bond market will help them to get better returns overall, or to like reduce their risk just by combining both stocks and bonds. And so then there's calculus that's involved in the background, but there are a lot of really nice tools which can like do the calculus for you, and so you won't have to be doing derivatives or integrals. or any sorts of differential equations for optimization purposes. But yeah, calculus actually does end up being very helpful when you're trying to optimize your portfolio. Doesn't necessarily mean you need to know, say like really high level math in order to optimize your portfolio, but calculus does work in the background when it comes to making the best possible portfolio that minimizes your risk.
Dude, yeah, he mentioned a hedge fund there, so we should maybe think about making one of those too, you know. But man, yeah, I mean,
that would be fun.
I mean, going into that, dude, you know, I mean, if we come up with some questions, some things like you were mentioning, like the correlations and like maybe trying to figure out how to measure these things properly, you know, I could totally take this like offline too and like really try to help out too. I mean, I'd be interested in doing something like that, you know, add that to kind of some of the goals that I have for this year, you know.
Yeah, it'd be cool, I think, to have like a segment at some point in the show and in the future where we just like to discuss like Wall Street Saturday Labs, in essence, just to say, hey, this is what we're looking at right now. This is how we're trying to crunch the numbers and maybe make some sort of like new metric to help us like figure out what to do in the stock market, or to help us to better understand what's been going on in the stock market. And I'm sure like some of those ideas will end up being garbage, but that's like how you find the good ideas.
No, for sure, man. Yeah, I know we're getting a little bit further along in the show, you know, so I kind of want to move it to another section. But one thing that is also in the news that I don't know how big it is. I feel like it's big news. I mean, I feel like it's big news because when random people kind of come up to me and they kind of bring it up, like it's probably big news, right? It's like the story when that famous investor back in 1920, the shoe shiner was trying to give him an investment advice. And when he got back to the office, he said, "Sell everything. We're in a bubble." You know? But one thing that a lot of people are bringing up to me is this situation going on between Ukraine and Russia. And I definitely want to talk about that because I want to talk about the play that I have been doing, which of course I encourage you guys to do as well. But I don't know, has anybody been really keeping up with that? I know Misael's been sending some things here and there about it, but
yeah, for sure. I mean, obviously, Russia and the U.S. always have this kind of like weird relationship in terms of diplomacy and all that stuff. Obviously, we saw in 2010 they did invade Ukraine. I mean, not Ukraine, Crimea, and I think at the time Obama was president. And another fun fact: around that time, the barrel of oil was like $100 or $110, and that was probably one of the highest that it has been. So, but recently, obviously, I think it's been going on for about 6 months now. I mean, Russia has been pushing troops to the border of Russia and Ukraine for a long time now. And now, around these times, you know, the UK said, hey, that Russia's probably going to invade Ukraine in February. You better get ready. Obviously, the biggest thing that Russia doesn't want is for Ukraine to become part of NATO, which NATO is an agreement between the US and Europe nations that if one of them gets attacked, then everybody has to defend, including the US. The biggest one being the US. And obviously, Russia doesn't want that for NATO because if Russia does invade Ukraine, then everybody would have on in arms against that. So right now, Russia has 100,000+ troops, right? Mm. And we've sent like 8,500 troops. Like the US has sent 8,500 troops to Eastern European countries. Okay, not Ukraine. And so things are boiling up. I think officially, the Department of Defense hand delivered a note to the Kremlin, you know, and saying, you know, you want the Ukraine to stay out of NATO, and we're not going to guarantee that at all. So deal with it. And anyway, that's what's going on. Like, people are just waiting to see what happens. If Russia does invade Ukraine, it would not be a pretty picture. I think General Milley, you know, was saying that it would be horrific. It will be fast and swift, you know. Think 100,000 troops just go into Ukraine all at once and they're just clearing shop. It wouldn't be a pretty picture. So definitely a lot of, this is part of why the market is down, because of war rumors. And it also has to do with while oil is up. Oil is a big thing in times of war. Obviously, you need gasoline or you need some sort of diesel derived, gas for your tanks, for your Humvees. You need oil to make weapons, to make uniforms, to make socks. I mean, this is why you're seeing oil going up. And it's not a coincidence that the last time that Russia was like meddling into other countries, oil was like at an on-time high of $100 a barrel, and now we're seeing, I think a year ago, a barrel of oil was like $45, $55, and right now it's like 85 and 90. So you can see that correlation. People are probably moving into oil because of that. In case war does break out, there's going to be a lot of demand for oil, and we're seeing that. So definitely keeping an eye on that situation. It doesn't look too favorable. Again, the UK said that they had intelligence saying that Russia would perform like some sort of terrorist act within Ukraine to kind of start the war. But and the UK also says that they have plans to invade in February. So if January is bad, I think February will be even worse for the markets, because then the stuff will hit the fan, and then people will be scrambling to figure out what's going to happen. But definitely a serious situation, and we'll have to keep an eye out for what's ahead.
Yeah, to your point, Misael, I mean, things don't really look that favorable. To be honest with you guys, I was kind of trying to ignore this narrative as much as possible. I was just like, things are just going to blow over. It's not going to be anything serious. But it's been harder and harder for me to really ignore this narrative. I think about almost just over a week ago, the president of Ukraine was really trying to calm the nation, just to make them think that the war was not a certainty. But then shortly afterwards, President Biden said, "Yeah, my guess is that he being Putin, will move in. He has to do something." And so that's definitely stoked fear of war over like the past several weeks. And I guess for me, I've just been thinking about what kinds of plays would really benefit from a war. And so like some things like, say, like the oil industry, certainly, like you mentioned before, would be one industry that would benefit quite a bit. There was one scientific article I was actually looking at, which came out about 2 years ago, which basically showed that in times of war, oil prices begin to become really, really high in the first couple of years of war, but then eventually they begin to decline because higher prices like put a taper on the oil demand, because people just can't afford to be purchasing oil, other than, of course, governments. And then the oil prices eventually go back down. In addition, there was like a previous prediction with regard to, this was like also back in 2019, that if there was an Iran conflict, oil could hit $100 a barrel. And so there's definitely a lot of upward pressure that's being pushed onto the oil industry right now because of war fears. And it's obviously like war is it's just a terrible thing. No one really wants that, I guess, except for certain parties who are initiating them. But it's generally not going to be favorable for the economy. But it seems like there are, of course, certain sectors which would benefit, which is, of course, the oil industry, and probably maybe an ETF like DFEN, which actually is, of course, in defense. So those are probably two sectors to look at over the next month, like as fear of war is continually stoked.
The other aspect of this is natural gas. Interestingly enough, most of the European countries, including the biggest economy in Europe, which is Germany, rely on Russia to get most of their natural gas to power their homes and the schools or government buildings, et cetera, et cetera. So obviously, Germany is a big partner of the U.S. in terms of war efforts, always has been. And now they're faced with the situation where if they do support the US in terms of defending Ukraine, they may risk their population getting hit by Russia cutting off, natural gas, which is like a huge, super important resource. At the moment, it's funny. There was an article that said that they offered helmets as a response to the Ukraine crisis. They didn't offer to send people; they offered helmets. So that's how you know that they're really thinking about this hard, because they are between a stone and a hard place. They have to consider how that's going to work out. And in response to that, obviously, Europe and the US are working to kind of like transport liquid natural gas into those countries in case something were to go awry. The only problem to that is that, if natural gas is liquefied, you need like a special platform to unload what you need. And there aren't many of those around Europe. So yes, you would have access to the natural gas if the US does send natural gas over to Europe, but then you wouldn't be able to use it as fast as you currently do, because there would be that supply chain issue with the platform being able to unload. So, natural gas may be like another thing that becomes in high in demand. Obviously, Russia, Gazprom is like their biggest, it's like a national gas utility, like gas to other countries. So if Russia does get kicked out of that business because of war, we may see like demand for it increase a lot in the West, especially in the US. So also looking into how that's going to play out, with Germany being like the biggest economy in Europe and one of the US's biggest partners.
And to that end, I think it also just shows how globalization and like the global economy acts as kind of like a deterrent for war, because people are less, or countries are less interested in war when they actually have something to lose. Like when their economies are so tied to perhaps like who they are considering being like their enemy, then they don't want to, they're less likely to want to initiate a war, because that will actually cause a significant hit to their economies. Will occur and will cause increase in prices, which then will slow their economies down. So yeah, in times of war, obviously, defense, the defense industry can boom, but at the expense of pretty much everyone else at the same time. And I've also been looking at, say, DFEN. Just kind of like a way as to gauge how the market is processing the fear of war. And it's a little difficult to kind of use that this time around as a gauge, because overall there's been like a broader sell-off in the market. And so actually DFEN is down by about 10% over the past month. So, all else equal, I would say, if DFEN's not doing well, that means the market's not very concerned about a war being present. But maybe that's just because we have two competing effects, which is the broader sell-off and then maybe fear of war, which would boost DFEN at the same time. So far, it seems like the broader sell-off has had more of an impact than the fear of war or anticipation of war. But it's a little hard to tell right now.
Yeah, and also here's the other thing. Think about the situation currently in the US. A lot of production has been cut back due to the pandemic. And usually when people go to war, there's a lot of need for that. So you have this risk of going to war on one side, and then you have this, supply chain that is still trying to survive or come back to some sort of normal level. That may not be a good combination if the war does break out, So we may see rationing coming to the US, especially in staples, consumer staples, gasoline, all that stuff, which usually happens during a war. Rationing happens. So, I think, consumer staples, maybe Costco, Walmart, those may be also a good place, because they would be working with the government to just kind of provide some sort of backup in terms of, basic needs.
That's a good point, because maybe it could be that some of these defense contractors are already stressed so much due to their supply chain that maybe the extra demand from the government in the event of a war wouldn't actually help them that much. Yeah, they can drive up the prices, sure, but they can't really increase their supply as much as they would like to. So that could also present a problem and may partially explain why, like say, securities like DFEN haven't been performing as well as I would have expected, given the current geopolitical situation we're in right now.
To kind of jump off that too, I do, because I have DFIN right here looking at it. It does look like it's a triple leverage. That sounds like our group, right? And yeah.
Guilty as charged, my friend.
Yeah, no worries, man. But kind of like bouncing off of all of this too, DFIN, I'm gonna look a little bit into this as well. I was looking at it too. Now, it was just only down like 1% this week, 1.46%. But another thing too to kind of look out for, and I don't have anything in specific. I probably could have like looked into this a little bit more, but I know that in previous prehistoric Wall Street Saturday times, we have talked about the future of war, and the future of war being cyber. And I know that Russia is bringing over its tanks and its people and their cars, whatever it is that they have. But I think it's also worth looking into some cybersecurity companies. Right before the call, we were talking a little bit about Palantir, which I don't think anybody really knows what Palantir does. I mean, despite it being a public company, like they don't really like publish or public what they do. And so I mean, I gotta keep looking in myself, but my oil play, and I can actually like show you guys, because this one's actually been like pretty crazy. This right here, can you guys see my screen? Can y'all see GUSH?
Yes.
Yeah, so this is GUSH here. So yesterday I did pretty good. This is actually a double leverage, and of course our group is a triple leverage, but I could not find a triple leverage. So I've actually bought this like a few months ago. And the reason I did buy this is because obviously it's an inflation hedge, right? When inflation is an issue, the one thing that people can really justify raising their prices on are commodities, right? Your oil and gas, your electricity, even your internet. Xfinity tried to get me with that too, But yeah. But yeah, dude. So I've been in GUSH for a little bit. I managed a little bit of my parents' money, and so I also got this for them. But the thing that I really like about them is that this is despite what the market has been doing the past like week, even the past year to date, it's been up 18% this month. And I mean, the past 5 days, the past week, it's been up 18%. But and I credit this a lot to the price of oil, right? The crude oil is at $86 a barrel right now. And again, like prehistoric Wall Street Saturday conversations we've had, man, they didn't think that oil would go over $85 a barrel. I think the last time when it went up to 100, like the market crashed, So that's just another thing to kind of keep an eye out for, which could also be like another indicator, speaking about some of the measures that we have, maybe worth looking into the correlation between a market crash and the price of oil. But yeah, look, I mean, that's a little disappointing that it was up to 116 at one point, but from year to date, it's up 10%. So, I will say be cautious with it. Obviously, I only buy stocks when they're red. This one's a green. So, I mean, depending on what kind of a chart that you look at, you want to just be kind of mindful of where you get in at this. But I do think that as long as oil keeps increasing, and if something really does happen in Germany, between Russia and Germany, and there's going to be this demand for oil, really, or natural gas, whatever it is, energy, you can bet that this will probably continue to rise. And there was this thing, and I'm sure that you guys know this subconsciously, but there was this comment, and I think that Biden actually said it, and he said something along the lines of when all the grocery stores are empty, when they're out of stock, that's actually a good thing for our economy. And everybody was kind of like making memes and kind of poking jokes and stuff like that, but I get what he was talking about, and I'm sure like all of us on this call get it. It's like when I see things like that, obviously, like, right, we heard that there was a chip shortage last year. So what do? I saw AMD stock crash and I bought it, you know? Same thing with like this supply chain stuff, you know? And I was like, okay, definitely gonna grab some consumer discretionary here. People are gonna be like on the move for that stuff, right? And so I think that's and this is really more for like the viewers, if they're even still on at this point, you know, I hope that they are. But if they're still listening, you know, that's kind of how you find it. You know, you see this issue, and then I find the people who are solving the issues, and then I get into it, you know? And so that's one that I saw with Gush, you know, and that's why I'm continuing to rise with it and hold on to it, you know. And I know we're coming up here on the hour, our hour mark here. But you know, did you guys have any comments? I know you just went off mute, Josh. I don't want to push you off if you got something to.
Oh yeah, I was just going to say, like, with regard to, I guess, like the oil and gas industry, it's interesting that GUSH like has gone up so much. I mean, partially I think it can be explained by the fact that it's double leveraged, right? But I was also like doing some research into like to various like midstream limited partner ETFs as well as XLE. So basically, they're just like the ones who are transporting like natural gas and oil like in pipelines. So I really think that particular industry is quite profitable. But those like actually haven't been as profitable as, say, something like GUSH. So for example, one of the best options out there would be like XLE or ET, and ET is like energy transfer. Energy transfer has basically only gone up by 1 second over like the past 5 days, by about like 6%. So I guess it has like benefited from those increased oil prices, but not necessarily as much as GUSH. But I would say that it probably can be explained just by the fact that GUSH is double leveraged. But it also seems like, but it also includes like oil and gas exploration, whereas ET is just that in between stage, like midstream. So it would be interesting at some point just to dig in and see like which of these segments of the pipeline actually end up benefiting the most, like from higher oil prices. Is it going to be like upstream, so like oil and gas exploration? Is it going to be midstream, just transporting the oil and gas, or is it going to be downstream, like actually selling oil and gas at the end? So that's one possible thing to look into for the future as we consider the possibility of increased oil prices.
Yeah, just to kind of bounce off of that too, man. There was like a PDF that I might have sent you guys, man, maybe like a year ago, like literally. And I think it was kind of going over some of those streams that you were talking about, upstream, midstream, and downstream. And from my understanding, all the money is really made in the midstream, which if people who are listening to this call don't necessarily know what it means by upstream, midstream, and downstream. Upstream is like the exploration of it, like when you dig it out of the ground. The midstream is the transportation of it, and then the downstream is the selling of it. So like when you buy gas from like Chevron or Valero or whatever it is. But where I hear where the meat of all that stuff, like where the profits are like in that midstream. And so like when I try to like find like a oil and gas company, I try to find like a what do they call it, like when they do all three, an integrated company, you know. But if all else fails, I don't know if you know what what kind of are they integrated, or are they just like a specific? Oh, you're on mute, sorry.
Yeah, they're mainly focused on midstream. So
Yeah,
they are a limited midstream partner, which actually means that not only are they in midstream, but they are legally required to give most of their profits back to the investor in the form of dividends. And they also recently increased their dividend by about 15%, which will be in February. So that actually like caused like their stock to boost up by about 5%.
Oh yeah.
So.
Yeah, I did see your article about that. Yeah. With the little time that we had left, do you guys have any things that you are going to possibly make orders for this week? Because I have an article here that I wanted to point out, which for definitely some things that I was going to look at that are definitely, you know, obviously everything is on sale, like just about everything, right? So for me, just to kind of kick it off, right? This is an article here from Market Watch, and this was actually from Monday, but some of the stocks that were down pretty big, but some things that I was looking off of this list, Netflix is like, I'll give that an honorable mention, but I'm not too crazy about it. But NVIDIA, I think that went down pretty big this week. They're actually going to be, I think that they're going to be leaders in the metaverse. So I might look to get some more of that. Obviously, Tesla, that's a little controversial for me to say myself. And again, this is not like financial advice, right? Like this is just what I am doing, what I'm seeing. You guys know I love my AMD. So looking into that too. But I think that, oh yeah, the last one here. I can't forget Ford. Ford's my sleeping giant prediction as well. But those are the things that I'm looking into for this week for sure. I don't know if you guys had anything that you guys were looking into.
Obviously, I mean, we do. Tesla did beat estimates, top and bottom line. Definitely huge potential. I think it's, I mean, 800, maybe 900
Hmm.
price point. Definitely can go to like 1400 easily. And obviously, we work. I don't know how that fared in this correction territory, but we work is something that I'm looking at.
Hmm.
Yeah, so for me, I would say that I'm mainly looking into deepening my investment into TQQQ, which is the triple leverage version of QQQ. I think it does actually incorporate a lot of like the stocks we have just mentioned like over the last 2 minutes or so. So it includes like Tesla, includes like giants like Apple, Microsoft. So like basically a lot of tech. And I was also looking at it from like a modern portfolio theory as well perspective. And it turns out that that's probably one of the it's like one of the ETFs with like the highest Sharpe ratios out there right now. And even when looking at the drawdowns, those drawdowns can be quite severe. Like for example, when it came to 2020, TQQQ went down effectively by about it went down by about like let's see, for like basically 50%. But if you had like a combination of say TQQQ with SPY, with the maximum Sharpe ratio, you would have only lost about 30% instead of basically half of your initial investment. But over time, obviously, those investments recouped their losses, and additionally offered a substantial profit. So to that end, I'm looking to bolster my investment in TQQQ over the next week. Also, next week is something to look out for because a lot of TQQQ holdings or even QQQ holdings have earnings. So Apple already came out with their earnings, which was very good. Supply chain issues are going to be eased up a little bit, according to Tim Cook, in March. In addition, we're going to have like Amazon releasing like their earnings, PayPal's releasing earnings. You have just like several different TQQQ holdings which are going to be releasing earnings. And so far, even though we only have maybe Apple, or maybe a couple others as an example, this could be a good earnings season for TQQQ. But if not, I will still be boosting my holdings there just to raise my Sharpe ratio. So that's what I'm looking to do next week.
I mean, I should have probably said I would do the same thing, because those are always my defaults. I get people that text me, message me, call me, and they ask like, yo, I feel like I want to put my money somewhere. And so then I suggest like TQQQ, UPRO, one of those, right? Like either both, right? And they're always just like, well, what are those? And I tell them it's like the indexes, right? And they're just like, they're confused about the whole triple leverage. But to me, it doesn't make sense to buy like just like SPY or QQQ because you're buying that for the purpose of it like increasing in value, right? And if that is your like goal or your purpose, why not triple leverage it, right? But I mean, again, there's people in all stages of life, and I think that's where I'm at currently in my season right now. But people gotta determine their own materiality, determine their own risk. I mean, it is running a business, right? You're in charge of your own money, your own decisions, and you are punished and rewarded for the decisions that you make. So I mean, but enough with my rant. but, but yeah, other than that, anybody got any last words or anything?
Maybe just one quick one for me. Yeah, there's probably going to be like more volatility ahead as we look for like we could head more into like earnings seasons with say a lot of like these tech giants, as well as looking in March for maybe like a rate hike from the Fed. And they're just like there also could be war with Russia at some point. So we have all of these different catalysts which can affect the stock market either positively or negatively. And it's, like I said before, it's important just to see the forest through the trees. And so you might be tempted to sell just due to different things that are happening, but I encourage you just to have a longer term focus versus just trading emotionally and being swayed to like the left or to the right by different news articles. So above all, if you get nothing else from this session, stay long and stay green. That's the best way to make money.
Perfect. Perfect. Sounds great, man. Well, if nobody has anything else, man, appreciate it. Thanks, guys. I'll see you
Until next time.
next time.